Good afternoon, everyone. This is Savita at Inside ETFs. We'll get started with our graduate seminar in just a moment as we allow those in queue the opportunity to go ahead and get dialed in. We'll begin in just about a minute. We thank you for your patience. Hello, everyone, and welcome to our Inside ETFs University webinar series. Today is our final part of our 5-part series, concluding here with our graduate seminar, Active ETFs, Why This is the Year, and How to Blend Them with Your Passive Portfolio. I'm Savita Narona, Director of Conference Content here at Inside ETFs, and your host for today's webinar. Before I turn this webinar over to Claire O'Hara, our moderator for today's webinar, I'd like to take a minute to thank you, the listeners, for joining us today and to go over a few basic housekeeping items to enhance your webinar experience. Inside ETFs Canada will be offering CE credits for this webinar. CE credit information along with the certificate will be emailed to you within 6 weeks of today's webinar. At the bottom of your webinar console, there are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit a question. Our speakers are happy to answer your questions, so don't be shy to ask it when you think it. Our speakers will do their best to get through all the questions. However, if a fuller answer is needed or if we run out of time, our speakers will do their best to follow up to those questions and get them answered. We capture all the questions, so go ahead and submit them early. We will get to them as soon as we can. You can expand your slide area by clicking on the maximize icon located on the top right of your screen or by dragging the bottom right corner of your slide area. If you have any technical difficulties, please click on the help widget. It has a question mark icon and covers most common technical issues. An on-demand version of the webcast will be available approximately 24 hours after the conclusion of today's webinar, and that can be accessed using the same audience link you used today to log in. Our moderator for today's webinar is Claire O'Hara, Wealth Management Reporter at the Globe and Mail. Prior to the Globe and Mail, Claire spent 8 years as a staff writer at Investment Executive. She has written on a broad range of topics, including financial products, advisory practices, compliance and regulatory issues, social media business practices, and wealth management. She has an undergraduate degree in media information from the University of Western Ontario and a journalism degree from the University of King's College in Halifax. Claire, the floor is all yours.
Great. Thank you, Savita. And I'd like to welcome everyone to today's seminar on active ETFs. Today, we're going to be taking a closer look at the overall growth of active ETFs and where active management can work for an investor's portfolio. Today, we're going to be speaking with Steve Hawkins, President and Co-CEO of Horizons ETFs Management Canada. Steve has been with Horizons ETFs for more than a decade and has been Co-CEO since 2015. Previously, Steve was managing partner and a director with Joe Funds Management, a subsidiary of Jovian Capital Corp, and has previously held senior roles at First Asset Investment Management and AMG Canada. Horizons ETFs was the first Canadian ETF provider to launch active ETFs in 2009 and now manages more than $9.5 billion in assets, of which $4.3 billion are in 29 actively managed funds. As well, we are also joined today by Candice Bangson, Vice President and Portfolio Manager of Global Asset Allocation at Fiera Capital Inc., who sub-advises $3.3 billion in actively managed funds. Candice is a member of the Asset Allocation Committee, focusing on central banks and fundamental macro analysis. She also actively participates in the development and communication of the asset allocation strategy. Candice's career in the investment industry spans almost 11 years, including 8 years as an investment research analyst for Franklin Templeton, where she gained extensive experience with global macroeconomic research for asset classes, regions, sectors, commodities, and currencies. She also conducted multi-manager fund research and analysis with a focus on Canadian and global equity asset classes. I'd like to welcome you both, Steve and Candace. I'm now going to hand things over to Steve, who's going to provide us with an overview of the active ETF market, as well as some insights into where active management can work best in a portfolio.
Thank you very much for the very nice introduction, Claire, and it's my pleasure to be here today and on this webinar with a lovely panel and hostess with us. So that said, I'm going to jump right into the presentation. I'm going to walk you through quickly what's going to happen here today from a discussion perspective. We were the first and largest actively managed ETF provider in Canada. And as Claire said, Candace works with Fiera Capital, one of our largest sub-advisors of our fixed income suite of actively managed ETFs. On the agenda today, I'm going to talk quickly a little bit about really what is an actively managed ETF. There's a lot of misinterpretations of what that means in the marketplace right now. I'm going to talk about generally the growth of active ETFs in Canada, where Canada is from a global perspective as well. I'm going to talk about some of the issues with just passive indexing and why that's not necessarily the right default ETF strategy. You'd be surprised on people when you're talking on the streets and you talk ETFs and all they understand is S&P 500 passive index management. Then I'm going to turn it over to Candace, who's really going to walk you through some of the how the active management works inside an ETF, as well as some very, very specific perspectives from the portfolio manager, the firm themselves, Fiera, and where they can really take advantage of active management in an ETF portfolio for us. So I'm going to jump right in, a little bit about Horizons. Claire gave a pretty big 10,000-foot level. We run 81 different ETFs in Canada. We have 3 very distinct types of product offerings out there. We have our what we started Horizons with over 10 years ago is our Beta Pro lineup of ETFs. These are tactical trading tools for the direct investors. We have 25 products in that suite and just over $1 billion of AUM. Then we have our benchmark ETFs where we're trying to offer you access to traditional passive indices, but as well as certain thematics and types of commodities out there. And we have over $4 billion of AUM in our benchmark ETF listings. And those products really are very comparable to your traditional iShares, Vanguard, BMO passive index products. And then we have the main discussion point today is our actively managed ETFs, of which Claire mentioned that we have over $4.5 billion of active ETF AUM under management with ourselves and the 29 different products that we have listed on the Toronto Stock Exchange. So that really is our suite in itself. We target very different audiences with the different types of products, but our benchmark ETFs are primarily institutional. Our actively managed ETFs are primarily for retail investment advisors as well as the retail public themselves. And then we have our leveraged and reverse leveraged Beta Pro products, which are really for the direct tactical investor and are very, very specific to that channel itself. Getting into just the history of an ETF and what an ETF is, there's a lot of tradition with respect to mutual funds in our industry, and active mutual funds have been around for a very, very long time. An ETF is just simply a new type of technology to deliver an investment strategy to the end investor. We look at it as a disruptive technology that's been around now for just over 26 years. Canada was the first offerer of an ETF in the world, and we've simply been one step ahead and evolved the ETF landscape within Canada very, very progressively. If you look at it, and let's compare it to sort of the music industry when all music was produced and distributed on records, on vinyl, and then, that sort of shifted to CDs, in the 80s and 90s, and then you've got MP3 players, and you got the digitization of music into onto your iPhone and your iTunes and your iPad and all of these things where you can get the music in that way. And then nowadays, it's almost all live streaming. So the music industry, it's just a completely different delivery mechanism, but it's the exact same song. We've highlighted the Beatles here, and you have the traditional song way back, and then it's just continued to move along, and now you just download the exact same music. It's just being provided to you in a very, very different delivery mechanism than it was 40 years ago. So ETF is just a new technology, but it's really not that new. It's been around for quite a while, and it continues to evolve. And that's what I just want everybody to keep their minds open about is, ETFs is just a very new defined delivery mechanism for any different types of investment strategy. Today, we're talking about active ETFs. This is very different from the traditional thought about passive ETFs. What we consider to be an active ETF is a strategy that does not follow a passive benchmark that's publicly available. So, the biggest benchmark in the world is S&P 500. People all over the world know what the S&P 500 is. That is a very, very traditional passive index strategy. Here in Canada, we have the TSX 60, S&P TSX 60, XIU, which is the largest ETF in the world, oldest ETF in the world, tracks this simple passive equity strategy. With active ETFs, we're essentially delivering you the return of an underlying strategy very much the same as a mutual fund. So we have an active portfolio manager, an investment professional who's managing a portfolio. He's adapting or she's adapting that portfolio every single day to the changing environment and how they want to meet the investment objective strategy of the underlying product itself. So just like a mutual fund, there is an objective, there's a strategy. It's very, very specific. We have 29 different active ETF strategies out there. Every single one of those is very, very specific, and we have a different type of manager or a different type of strategy that is being wound up inside that active ETF. Inside active ETFs, we're simply allowed to use sub-advisors or internal asset management expertise to manage that specific mandate. So very much like mutual funds have done for 25, 50 years in Canada, we typically outsource most of that advisory professional activity. Fiera Capital, Candace is going to speak on behalf of them later on shortly. They manage over $3 billion of active fixed income ETFs for Horizons ETFs under 11 plus different mandates for us. Very, very specific objectives and strategies in that regard. Very much like the mutual funds out there, we can typically reduce trading costs with institutional professional managers, and we really do eliminate the need to be on top of the traded markets at all times. You have a professional manager who is sitting there in front of a screen all day long with traders all around them, with their operations group all around them, and they are clued into every single nuance of the market at all times. And that's why it's very, very important to have professional management, because who knows what's going to happen tomorrow, who knows what's going to happen the next day, but these are individuals that live in this world, that are projecting forward what's going to happen, are making their investment decisions today, they're structuring the portfolios today to meet the objective, to meet the strategy, in anticipation of what they believe in their professional view the market is going to look like tomorrow and the next day, or a week down the road, or a month or a year down the road. With active ETFs, generally, we've seen a significant growth in active ETFs. There's been a huge growth in ETFs generally speaking, but with respect to active ETFs specifically, there's roughly $5 trillion out there in ETFs. Roughly 4.8 is in long-only index strategies. But here we have active ETFs representing almost $100 billion of AUM now in active strategies in the marketplace, and continuing to grow very, very rapidly. Active ETFs, generally speaking, Canada has been the leader in active ETFs almost from day one, and the Canadian active ETF total AUM represents 20% of the global active ETF AUM out there. So Canada has been extremely progressive. An ETF is no different than a mutual fund. It falls under the exact same investment fund regulations for Canada, but it gives us the opportunity to just create that different mechanism of delivery. It's a different wrapper for very similar or almost identical strategies to what you've traditionally been aware of or exposed to through mutual funds. For active ETFs in Canada, we've seen huge growth, as we mentioned. Of all of the ETFs that were launched in Canada last year, there was 122. 52 of those were new actively managed ETF styles or different strategies, different providers. But we see active ETFs representing almost 50% of all ETF launches in Canada, which is a huge number. You're not seeing a lot of new entrants into simple, passive, traditional indexing. That space is very, very crowded with our top three competitors between BlackRock, Vanguard, BMO, and even Invesco, and even ourselves. But active ETFs give us the opportunity to bring new and innovative strategies into the ETF world, very much like the mutual fund industry has been doing for the past 50 years. Right now, there's 184 funds in the marketplace as of December 27th that are essentially actively managed, and that accounts for almost 20% of the ETF assets in Canada at roughly $26.1 billion. And again, that 26.1 is of worldwide of just over 80 billion of total active ETF AUM in the global space. Our active ETFs grew by almost 50% on a year-over-year basis on an asset growth percentage. So we're seeing huge underlying money coming into the active ETF space. And where is that coming from? These are people understanding that the mutual fund industry is no longer the cheapest and only option to be able to get the strategies out there. Active ETFs follow a traditional ETF setup. They provide for intraday liquidity. They provide for broad diversification. And now with active management, you're getting the ability to create any sort of investment objective and strategy that has traditionally only been in the mutual fund space, and now it is in the ETF wrapper mechanism out there for you. With respect to continuing along the lines of the growth of active ETFs, this chart really highlights where overall ETF AUM sits out there. A lot of people for a long time have been talking about strategic beta and is strategic beta active or passive. It really is a passive strategy. It is a very public strategy. It follows a very strict parameters. It just weights very specific factors that have traditionally not been there in the passive management space. We, as a traditional active manager, we would say we don't consider strategic beta as active because it follows a very strict set of rules. It will always make the exact same decisions with the exact same inputs every single time. Active is alpha generation. And active is somebody making an investment decision, or in the case of one of our ETFs recently, an AI system actually making the investment decision on behalf of the portfolio itself. And then you have your traditional passive, which has always represented a significant portion of the Canadian ETF marketplace. We see in December 2015 that passive represented 76%, and now at the end of 2017, it's only representing 70% because we've seen huge continued growth in active ETF management. You can see the strategic beta all along has really stayed reasonably consistent, grown a little, contracted a little, grown a little, but really staying on the same side. We see more and more money moving away from the traditional from a percentage of growth perspective from the traditional passive management. There's still lots of money coming into traditional passive management because of the efficiencies. It's just on an overall pie perspective, it's chewing up less and less of that pie, and active ETFs are really taking over on an overall growth basis. You even see from the number of funds that are out there, look at the growth in the number of active ETFs, from 107 in 2015 to 184 now at the end of December 17, and it's even 200 from there. Just giving you quickly breakdown, the one thing that I really want to highlight from a fees perspective out there in active ETF management, just looking at the very bottom line, the average active ETF management fee out there is 58 basis points. There's a big range still. There's 10 to 95 basis points out there, and again, these are excluding anything that has trailer fees attached to it. But look at that 58 basis points and look at it versus strategic beta, which is the third line up, or sorry, fourth line up there. We really are looking at 58 basis points versus 56 basis points from a strategic beta basis, where you don't have somebody actually making an investment decision. You don't have somebody adapting that portfolio for current market environment or for how they believe that current market environment is going to change for the future market environment. Traditionally, we're only paying very, very slightly more from a basis points perspective for professional investment portfolio management expertise. And traditionally, when you're looking at this compared to mutual funds, these are much, much larger. You're looking at traditional mutual fund fees that are well over 100 basis points to 150 basis points. And are they really doing everything that they should be doing from a fees perspective in delivering you that professional investment management? I would say they've been probably living too high on the hog for too long now. We're able to deliver you the exact same strategies in a much more efficient trading vehicle in the form of an active ETF. Just want to highlight, indexing is not a one-size-fits-all solution. With respect to passive traditional indices, yes, they're highly liquid, they're very transparent, there's proper diversification with respect to the security class, but it's not always the right strategy for you. And we have to highlight the fact that you can get any different variation of an equity strategy or a fixed income strategy in an ETF now. And people are always looking at the passive benchmark strategies as the go-to returns. With equities, it's always traditionally been a much, much harder after fees to outperform the passive benchmarks, and that's why you see the S&P 500 as the largest ETF in the world, SPY. And, that really works for the traditional institutional investors who are investing government money, public money for the cities, and things like that. It's, those are all very traditional investors, endowment funds, things like that. But then when you get into certain asset classes, where we've found that there's a lot of inefficiency with respect to indexing, and I'm going to talk specifically about Canadian preferred shares, corporate bonds, high-yield bonds, senior loans, other alternative assets, and municipal bonds. These are very, very actively traded fixed income strategies, and a lot of them are very specific to Canada, but we've seen so much inefficiency in these spaces. And we've been able to, offer ETFs that follow all of these different strategies run by Fiera Capital, who have been able to, for a very, very low cost alpha generation strategy, been able to deliver significant alpha over traditional benchmarks out there. And this is much, much different than, again, the public equity space and the government bond space, where there's not a lot of alpha to be generated. Everybody can own a 10-year bond portfolio out there, and you're playing with simple, small basis points to be able to generate alpha on an overall basis. And same with public equities. The decision to own this equity over that equity and outweigh that one equity relative to the index so that you can try and outperform the index is a very, very time-consuming process, which does not always work well when you're looking on an after-fees basis. So sometimes it does make sense, in a lot of cases, to just own the traditional passive, lowest cost ETF or most tax-efficient ETF that provides access to one of those types of strategies. When I'm just talking quickly about active ETFs, from a bonds versus equities perspective, again, back to my points about where you can traditionally have seen outperformance. This is a report out by PIMCO on the left side of the chart that talks about bonds, and in all the different categories over many of the different, I'm going to say, time horizons of owning mutual funds. Look at the percentages of potential outperformance with those different categories over those different periods of times. Traditionally, it's more than 50% of active management can outperform the median of the benchmark out there for bonds. When it comes to equities, that is not the case. In almost all the equity categories, you're looking at less than 50% of the active mutual funds and ETFs that are out there are able to deliver returns that will beat the ultimate benchmark that you could have owned for very, very low cost and in a very riskless but well-diversified portfolio. So it's very important to understand, the Canadian marketplace has really provided a fertile ground for bond outperformance on the active side of things, and a lot of it is primarily due to the inefficiencies of indexing and the benchmarks that are being done out there. And I don't know that we're going to get into this slide. This is just from a weighting perspective, just so you understand quickly, traditionally how some bond indices weight their individual holdings relative to the stocks. And you can, again, this provides, some of the rationale for the inefficiency with respect to traditional bond indexing versus equity management. In the bond index on the left side, the iBoxx investment grade corporate bond, bonds are weighted by outstanding debt traditionally in a portfolio, whereas S&P 500, as an example, is weighted based on the market cap of the company. And so as the market cap of the company grows, that weighting in the portfolio grows. In the traditional bond indexing, their weight really doesn't grow unless they issue larger debt. So it's one way of market or one way of weighting in a bond index portfolio, but it does show that there's a lot of inefficiencies because you don't necessarily want the debt to grow in a company for you to own more of that company. So taking advantage from a credit perspective and a quality perspective, understanding the term and the duration of these and the very specific nuances of all the different debt that is out there, that is what you need an investment professional for, like Fiera Capital. And that said, just quickly with respect to bonds and equities, understanding that bonds trade over the counter, they're not very transparent from that perspective. There can be thinly traded markets on an overall basis. Fixed income investment management firms, they're professionals that are out there from an institutional basis. They are looking at index strategies all the time. They have the ability to take advantages of some of the nuances and IPOs and changes to that fixed income market when securities are added or going to be removed from index portfolios. And they're able to know these in advance, and they're able to take advantage of that inefficiency from the fixed income index management to, again, deliver alpha and outperformance on an overall basis. Many of these indices have hundreds and hundreds of bonds in them. The Canadian Aggregate Bond Index has well over 1,300 bonds, but nobody can own all 1,300 bonds in that bond index because so many of them are so illiquid. So you'll traditionally have a 500 to 700 name portfolio when there's 1,300 names in the index. there's a lot of stratified sampling going on. There's a lot of representative portfolio going on. But all of these things create tracking error when you don't own the exact securities of the index in the same weights that the index does. So again, a portfolio manager who's actively managing the portfolio, they're going to stick to the more actively managed, higher trading, better credit quality, less complicated structures that they're aware of, and they're going to be able to take advantage of the thinly traded markets to make sure that they are delivering alpha on an overall basis, whereas that passive index really has to follow that strategy, which can be inefficient. And all of that said, I'm going to now turn it over to the lovely Candice to talk about how Fiera actually applies active management into fixed income ETFs. That said, Candice, it's all over to you.
Great. Well, thanks so much, Steve. And thank you, everybody, for joining this afternoon. I thought I would just start out by providing you with a quick sort of some background information about how we look at the world as global asset allocators. So essentially, and what you're going to see in my presentation is that we're really looking at the investment landscape from a top-down perspective. And our goal is obviously to identify opportunities to add value for our clients. And this is done by, sort of searching out market dislocations and inefficiencies and really adapting to the macroeconomic backdrop at hand. So the way that we do that is, really by taking a top-down approach, looking at the global growth backdrop. Central bank policy comes into that perspective a lot as well. And that's really going to be the main driver of our top-down asset allocation decision. But then, of course, we are taking a more granular approach at things as well, looking beneath the asset class level into regions, sectors, et cetera. So you'll see that later on in my presentation. So what I'm going to take you through now is our assessment for the next. We typically look at things from a 12 to 18-month perspective, but of course within there are some opportunities to be exploited as well. But I'm going to take you through our macroeconomic assessment, focusing on, again, those two pillars of our research process, being number one, the global growth backdrop, and number two, central bank policy. And that will provide a good lead into our outlook and our forecasts for the next 12 months. And with that, our investment strategy and the implications for various asset classes and, of course, sectors, and focusing specifically in the fixed income space. So on this first slide here on the global economy, what I'm showing you here is the global manufacturing PMI as well as some of the regional PMIs. These are purchasing manager indices. These are essentially surveys that typically are a fairly good representation of, or a barometer for the health of the economy. And what this chart is showing you is that the global economy is in fairly robust shape and fairly broad-based as well. So the black dotted line is the global PMI, where firmly in expansion territory. That's the line that divides the 50 mark there. So you can see that the black line has been firmly in expansion territory since, the beginning of 2016. But most encouraging about this chart is the fact that all major regions are also in expansion as well. Not just the U.S. A couple years ago, it was all about the U.S. Driving the global economy, but now we're seeing that things are becoming more synchronous and widespread across the globe, which just means that the expansion is that much more entrenched. Now, I'm sure a lot of you have heard in the news, particularly over the last month or so, about, global growth is cresting. It's turning over. It's turning lower. And you can sort of see that here in the PMIs in the last month, where they have sort of peaked and then now dropped a little bit lower. But the good news is that these are still firmly in expansion territory and are essentially consistent with what we believe to be still a very healthy global growth backdrop. Just a few comments on some of the regions. I won't go into too much detail, but obviously the U.S. is really, again, leading the growth charge here. You've got a strong consumer backdrop, business spending, both of these obviously benefiting from, newly implemented tax reform from the Trump administration as well. But in general, the U.S. is in great shape, and now you've got this double dose fiscal stimulus coming at a time when the economy is already booming. So this, we feel, is going to extend the positive growth trajectory for the U.S. economy, and also have positive spillover effects for the global economy in general. Specifically in Canada, now obviously 2017 was a great year for the Canadian economy. G10 leading growth, the Canadian economy was really firing on all cylinders. And what we're seeing now here in 2018 is a moderation, but to more self-sustaining, but still above trend levels. So the backdrop, while indeed slowing, is still fairly healthy. The consumer has been able to absorb these latest interest rate increases from the Bank of Canada because of a fairly healthy job market. At the same time, we expect that stronger U.S. growth backdrop to expedite the rotation from the consumer and housing sectors of the Canadian economy towards more external sectors such as exports. And of course, this is, considering that NAFTA does not get ripped up, which is our base case, is that they do come to some sort of amicable agreement on the trade front. So things for Canada slowing, but still very much, above trend. And, of course, we're starting to see this in some of the inflation numbers. Looking abroad, previous laggards such as Japan and Europe now growing at fairly impressive rates, for their historical comparisons. Europe is growing at its fastest pace in 10 years. Japan also broad-based gains across both the consumer and the export and trade sector as well. So really stepping out of that deflationary mindset in the economies abroad. And then finally for China, the Chinese economy has really all but defied expectations for a hard landing. We were hearing a lot about that the last few years about this, hard landing expectation in China, and we're not really seeing this come to fruition. What we are seeing in China is fairly stable growth results, smack dab in the middle of policymakers' growth targets, but also the underlying activity data has also been fairly consistent with, renewed momentum here this year. So we're not expecting double digits or anything by that means from China. The Chinese economy is undergoing a transition towards more sustainable growth, which is going to necessitate some slowdown, but nonetheless, we don't anticipate a hard landing in China, and the growth is going to be strong enough to influence the rest of the global economy as well. So all that being said, the global economy remains on solid ground. So with that, it's not surprising. You've got above trend global growth, tighter labor markets, rock bottom unemployment rates, and of course recently here stronger commodity prices. So it's not surprising to see that inflation is starting to show some signs of life. Now here I've got headline inflation for several major economies, and what you can see here is that you've got the U.S., Canada, and the UK really coming in on the higher levels on the inflation front. But the good news is that these levels are not threatening, or they're not really signifying overheating conditions, and really allowing central banks to take their time in normalizing monetary policy in response. So it's not surprising that with, Canada, we just saw last month that inflation did indeed tick up quite substantially, closer to the Bank of Canada's target. In the U.S. as well. The UK, it's a bit of a story about pound weakness, but still still, between the Bank of England, the Bank of Canada, and the Federal Reserve, these three central banks have really been leading the normalization cycle here with rate increases. Now, in contrast, you've got Japan and Europe, where inflation is still fairly subdued, and this is allowing them to maintain their stimulative monetary policies and really leaving the overall backdrop quite compelling in general from a liquidity standpoint. So really the story here is one of, the end of deflation, but inflation slowly making a comeback, but not to the point where policymakers have to step on the brakes with their accommodative policies. And so that takes me to the major liquidity backdrop for the global economy. And here I'm just showing you the big three central bank balance sheets. And, so we've got the Federal Reserve, we've got the European Central Bank, and the Bank of Japan. Now, in aggregate for 2018, central banks are still going to be net stimulative or, a net positive for liquidity. So while the Federal Reserve is indeed reducing their balance sheet, you've still got the Bank of Japan and the European Central Bank buying assets and overall leaving the central bank backdrop, still positive for, the risk backdrop and just really lending support for 2018. Now, in 2019 is when things are going to likely shift a little bit more in the hawkish direction, because in 2019, not only are you going to have the Fed reducing its balance sheet, but the European Central Bank is also likely going to have plateaued as well, so less support there. But the Bank of Japan, of course, with the subdued inflation backdrop there and recent comments from policymakers, they aren't even really contemplating an exit from their stimulative policy. So 2019 will be less supportive, but still, adding some, support from the liquidity standpoint. So in general here, the story is really one of ongoing support from central banks, creating a fairly compelling backdrop for riskier assets and allowing that global economic recovery to continue on uninterrupted here for at least the coming year. So with that, this is basically the way that we look at the world from an asset allocation perspective and how we build our outlook and our investment strategy. So you can see here, I've got 4 different scenarios that we've built for looking forward about 12 to 18 months. On the left-hand side, you can see our main scenario, which is one for a synchronized global expansion, and that's essentially the environment that I just described, where you've got stronger global growth, signs of rebuilding pricing pressures, but not to the point where central banks have to aggressively step in. Now we've also got the added benefit of fiscal stimulus from the world's largest economy. So this all should bode fairly well for riskier assets and for equities, non-government bonds, that sort of trade going forward. Commodities, it's really very much a reflationary sort of scenario. And we've got a 60% likelihood pegged on that base case scenario. But of course, when we look at the global backdrop, we have to look at the entire picture. And of course, that means assessing the risks to our central scenario. And right now, as I'm sure all of you are exhausted of hearing about, the main risks to this scenario are really geopolitical and political in nature. And it's interesting because when you look at this grid of 4 scenarios, the markets always, temporarily price these scenarios over time, albeit for a very short period of time. Now, our expectation is that over the coming year, the synchronized global expansion is really going to drive and offset those main risks, being trade protectionism, political instability. But of course, we have to take these into account when we're making our investment decisions. So trade protectionism, obviously, this is what the markets have been pricing March and April. And this is really on the back of the sort of stepped-up protectionist rhetoric that we've been hearing from President Trump here. So obviously he spent 2017 really focused on those pro-growth policies, whether it be tax reform, deregulation, and 2018 has been more about trade. So whether it's been NAFTA renegotiations, but most prominent in this scenario is really the China trade relations with the U.S. And this is really what we've been saying from day one, is that the U.S. is really going after China. We've had some up and down revelations here in the last month. The start of worries about a global trade war, but again. It really looks as if the global growth backdrop will offset a lot of this. And a lot of what we've been hearing on the trade front has been rhetoric and noise rather than, fundamental action. So we do have a 20% likelihood on this risk scenario because, of course, it is what we're keeping our eyes very closely, on at this time. Because, of course, this could potentially derail the global economy. But as I mentioned, that wouldn't be our base case. The next risk scenario is political instability, and this is actually something that we haven't really been seeing at all in the marketplace. We've got a 10% likelihood on this scenario, and it's really stemming from Europe and that trend towards populism, which we haven't really seen come to fruition here. 2017, we had a number of big elections in Europe, and the anti-Euro Eurosceptics never really gained a lot of ground. Our concern, although, remained Italy, and indeed here this year in March, the Italian elections did reveal that the populists and the Eurosceptics did gain some ground. So the market really didn't react. The market was a little bit more focused on both the central scenario and the trade protectionism, but this is, again, something that we want to keep our eye on because, of course, this is coming at a time when Brexit negotiations are still underway and the future of the UK and obviously Europe trade relations still remain uncertain. And then finally, our last scenario is for stronger growth and inflation. This is actually a bit of an upside scenario, and it's actually what the markets were pricing in February. So while in January, markets, obviously we came into the new year, had a blow-off top in the marketplace. That was really the central scenario being priced. February came along, and whoops, we started to see inflation moving higher. That resulted in interest rates moving higher in accordance, and it really spooked investors into thinking that higher rates would derail the global expansion and corporate profitability as well. And of course, these concerns did prove to be unfounded as inflation did kind of pull back there again. But again, it's just something else that we're keeping our eye on. In this scenario, we would see much stronger global growth that would result in, a big comeback in inflation. And that in that case, central banks would have to, step on the brakes and start raising rates a lot faster than what the market is expecting. But we don't see this, even I would argue that the probability is even less than 10% at this point. So this is really, again, just the way that we're looking at the world at this time. But our main scenario continues to be for this reflationary Goldilocks, not too hot, not too cold economic scenario for 2018 at least. Now, I know this is a very busy slide, lots of information, but this is essentially part of our process where we review and make economic and financial market forecasts for each of those scenarios. And I'm really just going to focus on our base case or our central scenario for a synchronized global expansion, and I'll just highlight some of the key points. As I mentioned, we do expect stronger global growth. Mainly that's going to be driven by the U.S., but Canada is also going to have a decent contribution as well. But the story with the global economy is really going to be driven by the U.S., being that we do have that additional fiscal stimulus in place. Of course, with stronger global growth and higher commodity prices, improving labor markets, we're going to see stronger inflation. That's going to result in central banks continuing to normalize monetary policy. So we've got 2 more rate hikes penciled in for the Bank of Canada this year. The market's pricing probably closer to 1. The Federal Reserve, we've got 3 more rate hikes this year versus the Fed's forecast for 2 more. And the market expectation for 2 to 3 more. So we're a little bit more hawkish on the rate front just because we are a little bit more optimistic on both growth and accordingly inflation. And with higher inflation and stronger commodity prices, we expect yield curves to steepen and the long end to move higher as well. Profit growth with stronger global growth and higher energy prices, commodity prices in general, we expect earnings to be well supported. The last several years have been driven largely by multiple expansion. We think earnings are going to play a bigger role in equity market results in the coming year. And then finally, on the currency and commodity side, we have a fairly bullish call on crude. We've got a $72 target. And of course, that's really what's driving our bullish call on the Canadian dollar, where we've got an 85 US cent target versus about 80 cents today. So what does this all mean when it comes to, investing and asset classes? Here, this is our asset allocation strategy, and right now we're in the middle of a couple scenarios, as I showed you a few slides ago. But in general, we are overweight cash. You can't see that in this slide, but we're overweight cash. We're sitting on quite a sizable allocation in cash right now because we reduced our equity holdings back in December. And that was really a call on, I talked a little bit about identifying dislocations and market opportunities where things aren't inefficiencies, I guess is the word I'm looking for. At the end of 2017, we had a great year in equity land and, some great returns. We were overweight. And while the growth and that central bank backdrop did remain and still do remain extremely compelling, from a valuation perspective, a technical perspective, and even from a sentiment viewpoint, we thought that things were looking a little bit overdone from an equity perspective. Valuations were extremely stretched, investor confidence, euphoric conditions. Everybody was on the same trade. The equity trade was really crowded. So what we did is we reduced our equity allocation. After a very strong run-up. We did something similar in the fixed income space as well with the corporate high yield, preferred shares space. These sectors did extremely well last year, so we took some profits. And what we're doing right now is holding on to cash opportunistically, because in general, our bias for 2018 is to remain or to reestablish that overweight risk asset allocation because of the compelling macroeconomic backdrop. The fundamental underpinnings that really drove the rally last year in 2017 still remain intact here this year, but from a valuation perspective, we expected a little bit more volatility, a little bit more risk off, and that's really what we've been seeing here in the first quarter of 2018. So overall, through that, though, within fixed income, we maintained our underweight. We've been underweight fixed income as a general asset class, just looking at the universe for a couple years now, actually, in anticipation for rising interest rates. Our view continues to be that rates are moving higher, and of course this will be inherently negative for fixed income prices from an aggregate basis. But the good news is that there are still opportunities in the fixed income space to add value and to outperform your typical, universe benchmark. So while we're underweight government bonds in the environment of rising interest rates, we continue to have a preference for, shorter duration plays. Obviously, we want to hedge that interest rate risk as much as possible. We continue to like corporate and high yield just the way that we like equities for 2018, but within the fixed income space, like I mentioned, after a very strong 2017, corporate and high yield spreads fell back to pre-crisis levels. So a lot of the easy money had been made. So what we did was we took some profits at the end of 2017 in both the corporate and high yield space as well as preferred shares, and are holding on to that allocation in cash, waiting to opportunistically deploy that back into these sectors because we do think that they will outperform a traditional universe mandate in the coming year. The story, though, is not going to be as much about capital gains in the corporate high yield space. It's really going to be one of carry, but then underlying support for these sectors due to the low default risk and the stronger fundamental backdrop. And emerging market debt is another asset class that we continue to like, both on the equity and the fixed income side, for much the same reasons. Stronger global growth, much more sound finances in the emerging marketplace versus, say, 5-10 years ago. This is all creating a fairly compelling environment and opportunities for value add in both the fixed income and the equity space. So I think I'll leave it there, and I will I'll flip the webinar back over to Claire.
Thanks, Candice. I appreciate both Steve and Candice's time, and at this time I think I want to open up the floor for some questions. We just have a few minutes here, and just a reminder, there is a Q&A box on the upper left side of your screen that you can type your question in the lower box in your screen there. To start off, I think I just wanted to address, maybe for Steve, for mutual fund advisors who can't access ETFs, what are your thoughts on, perhaps fund of funds that might package ETFs into those, and typically they do come with higher fees, but are there any options for those advisors to access these strategies?
Yeah, there's. Thanks, Claire. I mean, there's the market continues to evolve all the time. The regulators are completely on side with mutual fund dealer shops being able to sell ETFs with the appropriate course background. Right now, it really is the systems of those mutual fund companies catching up with the products that are now available to them. And there's some mutual fund shops that are making them available now, but traditionally, up until now, it really is only mutual fund wrappers of ETFs that are available. And I would say predominantly that's all that's really available to those MFDA reps at this stage, unfortunately. That said, I would say things are going to change very significantly in 2018 for access to different strategies for mutual fund dealers. And, typically this could mean some sort of fund serve access for the ETF themselves directly, so they're not going to be trading it on the exchange intraday necessarily, though that is an option if their operations can catch up to it. But there will be facilities available for MFDA advisors to buy ETFs through an end-of-day execution platform.
Great. Our next question is for Candice. And so what has been the historical performance after fees of FIER's mandates?
Sorry, our asset allocation?
No, it's more just your outperformance generally, Candice.
Oh, okay. So we've been doing asset allocation since, the team anyways, since 2006. So in general, we have a track record since inception of adding value over time. 65 basis points a year annualized has been our since inception result. And over the last year, I don't have the exact numbers in front of me, but about 100 basis points in the last year of added value.
And I would say, like in preferred shares as an example, we charge 10 basis points over the traditional passive benchmark preferred share products, but we've typically been able to deliver between 200 and 300 basis points of alpha after fees over top of those passive preferred share benchmark products.
Great. Well, thank you again to both Candice and Steve. Unfortunately, that's all the time we have for today, and I'm going to turn it back over to Saveda.
Thank you, Claire, Candice, and Steve, for your insight on today's webinar. I also wanted to take some time to thank Roger Chandock and Frederick Bigger from National Bank Financial Group, Christopher Dahl from Invesco Canada, Pierre Daly from AdvisorAnalyst.com, Alfred Lee and Kevin Prince from BMO Global Asset Management for the insight on our Inside ETFs Canada University webinars that happened over the past 5 weeks. I'd like to thank you, the listeners, also for joining us today and for joining us over the course of the past 5 weeks. A reminder that a replay A reminder that a replay of today's webinar will be emailed to you within 24 to 48 hours. If you like what you heard today and want to learn more about active ETFs, the current state of the Canadian ETF market, or the latest investment trends and strategies on how to best use them in client portfolios, join us this June 21st and 22nd in Montreal for our first Inside ETFs Canada conference. You can register at InsideETFsCanada.com. On behalf of everyone here at Inside ETFs, thank you again for joining us. We appreciate your time. Look forward to meeting you at Inside ETFs Canada. Have a wonderful day.
Thank you, Savita. Thank you, Claire. Thank you, Candice.